Fear of losing money, not having enough knowledge about the market, being too lazy to put in time and effort to learn about the market. Is this what is keeping you away from entering the world of the stock market? Then this video is for you. What if I told you there was one equity stock in the market which you can invest in without learning anything about its fundamentals? Yes, that is what we are going to talk about today. You might have guessed it from the thumbnail and title. It is Nifty itself. So let's get right into the video. This is Ajay Ajith. Welcome to MarketFeed. Now that we have understood the secret investment that is Nifty, let us talk how Nifty works in the first place. What is Nifty and how is it even calculated? So Nifty is basically what we call as Nifty 50. It is India's top 50 companies. That is all you need to know. But if you want to learn more in depth about it, it is an index which tracks the India's 50 largest companies based on free float market cap. I hope you know what market cap of a company is. Market cap is basically the total number of shares multiplied by the share price of the company. Now, how is free float market cap different from the normal market cap that we know? Free float market cap only takes into account those shares which are readily available in the market. So, if a promoter holding in the company is 75%, that means if in a company, the promoter himself is holding nearly 75% of the stocks, like maybe Adani Enterprises, the free float market cap will only be calculated based on the remaining 25% shares. This is one reason why Adani Enterprises, which is India's 11th largest stock, is still not included in Nifty 50. We also said that it's a market cap index. So what is that? Basically, a market cap weighted index means that companies with a larger market cap, larger companies will get a higher weightage in the index. That means if Reliance moves, which is India's largest company, right? If Reliance share moves up, it will have more impact on Nifty 50 than if an ICICI Bank or even an Infosys moves up. So in general, we can say that Nifty 50 moves up when the 50 stocks inside it moves up, and it moves down if there is a small fall in all of these stocks. So I hope you understood what Nifty is and how it works. Now let's get on to why we should invest in Nifty in the first place. So there are three major reasons why you should be investing in Nifty 50. The first reason is you can invest in Nifty without knowing anything about the company's fundamentals, because this is an index which is consisting of the 50 largest companies in India. There is a diversification, right? Money is divided into each of these stocks, and also these are India's 50 best stocks, right? What is there to worry about if you believe in India? Now this is where you can ask, Ajay, what about companies like Idea and Yes Bank, which were previously in Nifty 50 but now are nowhere to be seen? So now is where the second reason comes in. Every 6 months there's a review in Nifty where the weightage is changed. Right, if a stock moves down, its market cap also moves down, and the weightage of that particular stock in Nifty reduces. That is calculated every 6 months. And in every year, once every year, the entire Nifty is re-looked at. Things are shuffled, stocks are pushed out, and new stocks are brought in so that it remains as the perfect index of India's top 50 companies. For example, we saw recently that Indian Oil Company was pushed out of Nifty and Apollo Hospitals was brought in. This was done on the basis of the yearly reconstitution of the index. So if you are an investor in the market, you should always be worrying about your portfolio. You should be always worrying about rebalancing your portfolio. But if you are an intelligent investor and you invest in Nifty itself, then they will do all the work for you. You just need to sit back and relax while our nation grows and our top 50 companies move up. So the third point is that Nifty often beats mutual funds. Yes, that you heard that correctly. Nifty's performance often even beats that of mutual funds. So if you know that mutual funds have a fund manager, they sit there and they decide which stocks to buy and which stocks to sell, and they keep on managing your portfolio depending on the money you give them. And for Nifty, there is nothing like that. It is totally automatic. And if you have a method to invest in Nifty itself and it gives you even better returns than investing in mutual funds, then why not? So in this Excel sheet that you're seeing on the screen right now, we have calculated the 5-year average returns of mutual funds and even Nifty in India. So Nifty in its total existence, that is nearly more than 20 years, it has given a compounded annual growth rate a CAGR of nearly 14%, in fact even touching 15%. As you can clearly see in this Excel sheet that I have made, you can see that Nifty has given an annual return of nearly 13% in the last 5 years, and when you look at India's top equity mutual funds, they have not given more than 14%. Even the best ones have given only 14%. Smaller ones have given 10%, 11%, 12%, not even beating Nifty. And also comparing to mutual funds, you know the recent Axis mutual fund scam, right? And you don't need to be worried about anything like that with Nifty because it's automatically calculated. There is no serious fund manager who sits there and decides. It's a passively calculated index is what I'm saying. Now that we have talked about what Nifty is and why you should be investing in Nifty, let's talk about how you can invest in Nifty. So there are many methods to be investing in Nifty, and we have gone through all of those to select the best ones for you. The first one can be futures, but that is mostly a tradable instrument, and let's not get into that. Just understand that it's not a good instrument for investing in the long term. So the second is investing in Nifty yourself. You can take note of all the 50 companies in Nifty 50. You can take the market cap, you can take the weightages. It's all publicly available information, and you can start putting money and managing money on your own. But this is not very effective because you'll need a large sum of money to be doing this on your own. So let's ignore that as well. And now let's get to the third point, which is a Nifty mutual fund. It is a mutual fund which tracks Nifty itself. And again, mutual funds have high charges, they have high expense ratios, they have exit loads. So let's not get things complicated. Let's get into our best investment option that we have for investing in Nifty, which are Nifty ETFs. So talking about ETFs, in simple words, these are kind of like mutual funds which can be traded via your broker directly in the stock market. So investing in ETFs is very easy. You just have to open your broker's terminal. If you do not have a broker, you can click on the link down below, open a broking account, and you can start investing in Nifty. So these ETFs act like stocks which you can buy and sell easily from your broker that track Nifty itself. So when Nifty moves up, these ETFs will also move up, and when Nifty moves down, these ETFs will also move down. It is almost like you're investing in the top 50 companies in India itself. And out of the major Nifty ETFs in India, the best one is what we are going to talk about today, Nifty BeEs. So once again, you need a demat account with a broker to buy and sell Nifty ETFs. Now once you open your broker's terminal, just search Nifty BeEs as shown in the screen down below, and you can easily buy and sell it like just any other stock. So now that we've talked about what Nifty is, why you should be investing in Nifty, and how you can invest in Nifty, yes, through Nifty BeEs. Now let's get into the advantages and disadvantages of Nifty BeEs. Coming to the advantages of Nifty BeEs, the first one would be that it is just costing 180 rupees. That is nearly 1 by 100 of what Nifty costs. So it is very easy to invest in Nifty ETF, that is Nifty BeEs. So the second point is that Nifty BeEs, when compared to other ETFs, it has higher liquidity. There are more people buying and selling Nifty BeEs so that you will be able to easily trade in it. So the third point, despite all of this, the charges are lower. So even when you're comparing to other ETFs like maybe the one from SBI, the charges are lower in Nifty BeEs. The tracking error is also lower for Nifty BeEs, and it is at par with industry standards. That means if Nifty moves maybe 1000 points, the ETF also tracks it almost perfectly. And also, as we have talked about earlier, we have seen that it has outperformed many mutual funds as well. And the one secret hidden advantage for stock market traders is that Nifty BeEs is a pledgeable asset. That means you can pledge the Nifty BeEs. You can go to your broker, you can ask them how much haircut they will give you. Most give around 90%. And if you have invested nearly 1 lakh in Nifty BeEs and you want to pledge it, you can get nearly 90,000 rupees in margin so that you can trade in the market. So what's happening here? You can invest any amount of money that you want for the long term, and you can also pledge that, get the margin and use it for short term trading and generate an income. So now let's talk about the disadvantages. The first important one, volatility. It is an equity only ETF. That means you're tracking just Nifty, just stocks in the market, and when the market moves up and down, it is quite a volatile asset. And if you want to withdraw money, maybe it is during some crashes, it will be really hard to do that. So always make sure that you're invested in the long term in Nifty Bees. The second disadvantage is that Nifty Bees moves up when Nifty moves up. What if there comes a time when Nifty moves sideways or Nifty moves down, a long-term bear market? So the basic understanding here is that if India's top 50 companies grow, Nifty would also move up. So in order for India's top 50 companies to grow, India would also need to grow as a country, right? So if you believe in India, then you should be investing in Nifty Bees. That means if the country goes into a long-term economic downturn, then things might get difficult. Maybe mutual funds will start outperforming and the Nifty might consolidate. So keep that in mind while you're investing in Nifty for the long term. So the third disadvantage is that there is no debt component in Nifty Bees. That is quite similar to the first one. So the problem here is that it is a volatile asset, and if you're investing your whole lifelong assets into Nifty 50, you will not have any liquid cash available. So in order to beat that, you'll have to invest at least some component of your money in fixed interest rate assets like maybe debt mutual funds or even FDs for that matter. Now let's get to the conclusions of this video and what we have learned from it. After Nifty launched in 1996, till date there have been many crashes in the market. You know about the 2008 financial crisis and even the 2020 COVID crash, and the market has recovered from all of that, and who else to invest in better than Nifty itself? So if you believe in Nifty and the Indian market itself, Nifty Bees is the best investment method for you. Yes, there are some drawbacks, and if you learn about these drawbacks and start investing in the right way, then you can surely make long-term consistent profit from the market. So we have learned all about what Nifty is in the first place, and we have seen why Nifty Bees is the best investment strategy. And with the video, we have discussed all about what Nifty is, what Nifty Bees is, the advantages and disadvantages for you to become a knowledgeable and intelligent market participant. So that's all for the video today. If you have any doubts about this topic, please do comment down below and let us know, and we'll surely be able to clear all of it. So thank you for watching the video. This is Ajay Ajith signing off. Bye bye.